Hello everyone, today I want to talk about one of the best index funds available to UK investors in my opinion. This can produce great returns that 70% of UK equity fund managers simply fail to beat. This index fund is a passive form of investment that does not require hours of research to do. This invests in the best companies in the world like Amazon and Google, whilst also passively investing back into itself without you having to do anything. If you get someone out of this video, then please consider leaving a like and consider subscribing to the channel to help it grow. So let's talk about index funds. Now everyone who watches this channel probably knows that I invest in individual companies. These tend to be monopolies or have a particular competitive advantage, and they all generally have a predictable free cash flow that I can help use to value a business. Now, I do this because I love the challenge and enjoy spending hours researching individual companies like these. But what about for the people that don't want to do that? What about the people that don't want to spend hours looking at companies they may never invest in? And what about the people that want to passively outperform most investors and just leave their investment and forget about it? So we're going to be talking about that today and talking about an options, specifically one particular index fund that I've picked out. Now, I was talking about this index fund with a friend the other day, and if I just wanted a complete offhand approach, there is one particular index fund I would choose. It's not VU because we are not in America and we cannot invest in it, but this is a direct equivalent. And that holds the same companies and is basically what every investor is trying to beat. The index fund that I am thinking of is VUAG, Vanguard S P 500 Accumulative. Now, this is essentially an index fund that tries to match the S&P 500. The S&P 500 being the biggest companies in America weighted by market cap, with the biggest holdings being the likes of Nvidia, Apple and Google. Now, lots of people will probably say, well, this is obvious. Invest in the S&P 500. This is not new news. But you'd be surprised because a lot of people that I know specifically don't really know this stuff. They want to do more with their money than just a high interest savings account, but don't really know where to start when picking an index fund that is diversified and safe. And this is where this may come in to help choose one. So this is the one I would pick. It's a hands-off approach to investing. And I was actually talking about it with a mate yesterday and he chose to invest in this one, which sort of inspired this video. So in the past year, VORG has actually been up over 28%, as we can see here. And that's actually outperformed the S&P 500 benchmark that it tries to emulate by a considerable margin, with it being up around 23%. Now, there is a reason for this outperformance, and it's not something you can guarantee into the future. It's probably due to the pound versus the dollar sort of fluctuating. The pound was quite a bit stronger than the dollar, and that may have led to a bit of outperformance. Additionally, what we might be seeing is this accumulative factor here, which is essentially where dividends are reinvested back into the fund passively without you doing anything. This particular fund actually has about a 1% dividend or around that, because the companies that are in it, the likes of Apple, Google, etc., all usually pay a dividend, and this varies depending on the company. A dividend is essentially when they pay you to own a stock. They pay out part of their earnings as a company in order to keep carrying on being a shareholder, which is obviously incentivise shareholders to keep holding the individual holdings, or in this case, the index fund. So we basically have two types of the same fund. They invest in the same things. They generally are identical to one another. The only difference is we have these two functions here, accumulative or income, as in it distributes the dividends straight to you and you can decide what to do with them. So this accumulation one is VUAG or VORG, the one we're looking at here. And this one here, VUSA, is another form of investment that I would think is very good. Now, this isn't as passive because you have to actually manually reinvest those dividends if you choose, or you can choose to take them out. But as we can see here, in the last year, it's returned about 27% compared to VUG's around 28 to 29%. So it's outperforming because those dividends are possibly reinvested back into the fund, I would have said. But if we look at what VUG is and what it actually generally has in its fund, we can see here on the Vanguard website that each individual share, if you like, of the index fund is £92. This generally doesn't really matter. The only difference is that generally you're paying pounds rather than you're maybe paying dollars, so you're not converting money, so you don't have to worry about FX. You have 503 stocks in this form of index fund, and the ongoing charges are very low. Now, what I would say is that this price of about 0.07% just simply is quite low for index funds in general. It's not an actively managed fund that carries high fees, and that's what you want as an index investor. I think more often than not, lots of people try to outperform and get higher and higher charges and fees. And this can lead to problems further down the line because it eats into your overall returns into the future. Now, what I will say is that the risk that they have for this fund is 6 out of 7. I think this is a bit outdated. I personally would say that the S&P 500, whilst not massively diversified, is still a very good investment and not highly risky. If this was 6 out of 7, then investing in individual companies will probably be a 10. So well above the 10 out of 7 that they've done here. So I generally would put this closer to about a 4 out of 7 generally as a form of investment, basing it upon the whole spectrum. But that's just me. Now, as we can see here, their past performance based on a lump sum investment in May even of 2019 of $10,000 is sitting at closer to about $23,000 now in December 2024. So it does show that it has a good track record over that space of time. But the S&P 500 has performed very well, so an index fund that tries to match the benchmark index of the S&P 500 is probably going to perform very well as well. And if we go through by exposure to see where we're sort of sitting in terms of companies that are in this index fund, it's all in North America. There is no foreign stocks, and there is no UK-based companies or anything like that. The market allocation is all held in the United States, and that could be a risk if you believe that the United States is going to be in some form of recession in the future or something like that. Personally, I think this is not necessarily a bad thing. We have such a thing as diversification for its own sake, and I think that maybe diversing away from the United States just because it's the United States is not the best idea. They have the best companies in the world. That doesn't mean that there's great companies outside of the United States. It just means that in this index fund there is quite a few good companies, and they are all in the United States. Now, the weighted exposure in terms of actual sectors is mainly focused in information technology at 32.5%. And that matches the benchmark that we're trying to beat, the S&P 500. Then we have the financials sitting at 13.6% and consumer discretionary at 11.3%, with materials and real estate making up lower portions of this fund. Now, what I will say is that it is not massively diverse anymore, unfortunately. The S&P 500 used to be quite a bit more like even and sort of even weighting. That sort of changed over time with the increase in certain companies. I would say this is not necessarily a bad thing for investors. Now, lots of people will say, well, you need equal weighting in your holdings because you don't want any particular ones dragging you down. But I would say that the reason that these have become higher percentages of this fund is because they have increased in market cap. They've increased in market cap because the share price has gone up. So do you want to continue having higher weighting towards winning stocks that are growing their company massively fast, or do you want an equal weighting index which underperforms this one? So Apple sits at 7.57% of this fund, Nvidia sits at 6.59% of this fund, Microsoft sits at 6%, Amazon 4%, Meta at 2.5%, and Alphabet actually sits closer to about 4% here with two forms of shares. So generally, this fund is not as diverse maybe as you may want, so I could understand maybe going with something else if this doesn't necessarily sit well with you. Now, another form of investment you may consider is the Vanguard FTSE All World Accumulative Fund. This has a good way of maybe getting away from a bit of that diversification with the likes of the S&P 500 and VORG, if that wasn't for you. Now, VORG would be my choice, but Vanguard FTSE All World Accumulative Fund, or VWRP on Trading 212, I would believe is a very good investment for a UK investor as well. Its last year return has been about 23%, and it has generally followed a trend going upwards. This is a good form of investment in general. It's got about 3,000 stocks in it. If we look over here, we can see that the number of stocks is about 3,654. It has higher fees, which is something I don't necessarily like about this fund. About 3 times, if not 4 times maybe, what the likes of VORG is. So that's something to bear in mind at 0.22%. But it is still relatively low. And the risk for Vanguard is still sitting at 6 out of 7, which I personally wouldn't say it is. I sit it closer to about 3 personally. Now, if we look at what's actually in the fund, we can see that its weighting is still heavily dependent on North America at 67%. So you're not getting completely away from this diversification. The reason for that is because North American stocks generally outperform everyone else. There's no massive reason for that other than the fact that North American companies generally do very well in terms of growth. They have an economy which sort of reinforces the growth for individual companies, and they already have in place massively good companies, the likes of Apple, Google, Nvidia, etc., that just keep popping up in this country. So this one is still weighted heavily towards North America. But they have 13.8% of Europe and 9.7% of emerging markets. And if we can see, you see that 6.4% is still closer to the benchmark index that they're trying to match, which is an all-world fund. They have all sorts of countries as weighted in this portfolio. Some don't have massive weightings, like Germany only has 2%, France has 2.2%, Japan has 5.7% weighting. And generally, this comes down to sort of whether you want to diversify away from the S&P 500 a little bit, but still be heavily invested in it, because it still is heavily invested in the massive stocks in the S&P 500. And then we've got technology, which sits at about 29% of the overall fund, financials sitting at 15.1%, and consumer discretionary making up 14.4%, with real estate and telecommunications making up the lower end of this fund in terms of sector weighting. So whatever fund you wanted to choose, if you wanted to choose an Invesco one rather than Vanguard, I would understand. I think that they have low fees as well, but a low index fund fee generally is what you want to go for, and you want to go for a benchmark index like the S&P 500 or an all-world ETF. And my personal choice would not be VUSA because it's a little bit more hands-on, but it is still a good investment. You've got the all-world one that we talked about, VWRP, which is an accumulative fund and still very good, but would underperform over the long term, I believe, against the S&P 500. And then we have VORG, which is my choice, which is the Vanguard S&P 500 Accumulative Fund. And that one, I believe, is very good as a fund in general on Trading 212, and probably be where I put my money. But that's just me. There's no massive data to back that up, and I haven't gone massively in depth in the research. But let me know what you think of this fund and what you might be investing in down below. And as always, thanks for watching. I do appreciate it, and I'll catch you in the next one.